So thanks everyone for joining us. My name is Jeff Stein. I'm the White House economics reporter from the Washington Post and broadcasting live here from our offices. Obviously, one of the most important questions facing Washington policymakers right now is the extent to which we can continue to spend as much as $1 trillion more every year than we collect in new revenue. And answering this question in turn requires answering another, maybe even more fundamental question, which is, how much longer can the US continue to borrow cheaply? Both sides of the debate that we're going to be having today agree that the federal government has been able to authorize trillions of dollars in new spending at essentially bargain rates, spending that helped prevent an economic collapse during the COVID pandemic, that saved millions of households and businesses from a far worse downturn, and that this low interest rate environment, persisting for 30 years or so at this point, has allowed Congress to justify spending bill after spending bill while keeping costs down. The question that policymakers must now assess is how long that bargain rate that we've had for this period will continue. Are we in a fundamentally new era in which demographics and other global economic conditions mean that the US can safely continue to run up federal debts? Or is the period that we're now in going to look later like an aberration? And we will rue the decision now to continue to escalate borrowing in a way that later turns into an economic planning nightmare. Joining us at this Manhattan Institute panel to discuss this very question, Brian Riedl, a senior fellow at the Manhattan Institute and former aide to Rob Portman, who was very generous to answer my reporting calls at all kinds of weird hours, and Alan Cole, who was a senior economist at the Joint Economic Committee and now writes for Full Stack Economist. Thank you guys so much for joining us. I'll just say that this discussion, it sounds very technical and very wonky. What is the long-term future for interest rates is not a headline-popping question, perhaps, but it is of enormous importance not only for policymakers, but for the fiscal health of the country and for millions of Americans who rely every year on government spending for their retirement, healthcare, and other vital services. So we're going to start with opening questions, and then I will pose a few opening statements, and then I'll pose a few questions to each Alan and Brian, and then we'll open it up to you guys. So thank you so much for joining us, and we'll start with Alan.
Hi, I'm Alan Cole. I'm with Full Stack Economics. First, I would like to say a couple of things that I appreciate about my co-panelist, Brian. First, his long-run outlook. I appreciate that Brian cares about the future. The general value system where we try to make the life for future generations better than the life for our own. That's important to me. I also appreciate his flexibility in looking at different measures, not just the headline numbers. For example, the Medicare and Social Security liabilities matter too. It's not just one number that you look at. It's kind of a unified federal budget system. And the question that we have before us is, whether we have too many financial obligations in our federal budget system. So what does it look like when a country's burden of financial obligations is too high? And I would argue that nominal interest rates are kind of the key hinge on which you decide this question. And obviously they are low right now, under 2% for most durations. And I expect that is likely to continue, which suggests that at least our current levels of spending, what we've typically spent over the last 10 years, let's say, is very sustainable. Although obviously I would say that the emergency COVID relief funding, you can't do that sort of spending indefinitely. Now, the reason that high nominal interest rates are a good measure is that they kind of encompass all of the different ways that borrowing could be a bad deal. High interest rates on debt are a little bit different for a country like the US that prints its own money rather than a person. The US doesn't default, it never runs out of dollars, but it can soft default through inflation, through not guaranteeing the value of the dollar to kind of a reasonable amount that people would expect, which is something around 2% inflation is what they've committed to. a principle called Fisher parity tells us that nominal rates are inflation plus real rates. So if your nominal interest rates are high, either you have high long-run inflation, in which case you need to tighten up your fiscal house and release less money into the economy, or else your inflation will continue to accelerate. Or you have high real interest rates, in which case paying down the debt just becomes essentially a good investment. It's a good deal because you get back more later than you paid in. And we don't have either of those situations right now. We don't have lenders with better options. Now, lenders to a country like, say, Turkey might say, we have better leverage, we're taking our money elsewhere. But that's not true of the US. In the US, we have low interest rates, not because we deserve them, not because we're especially, the most perfectly managed country in the world, but because borrowers are forced to accept them. There's a thesis that I very much believe in that comes from researchers such as Matthew Ronley, that demographics and wealth and global imbalances in the 21st century is a paper he recently released. And it's largely about how the desire for financial assets relative to GDP has gone up a bunch. And what's the main reason for that? The main reason is older people. It's people growing over 65 and wanting to fund their retirements. There are about 700 million such people in the world, and there's about 30 million new ones every year. Just a huge number of people have to do this thing in their life cycle where they save for a while, they accumulate this very large balance, and then they spend 20, 30 years in retirement. And that just naturally requires people to defer a lot of consumption. And that's something that's very different from where we've been in the past. Usually it was hard to find people who wanted to defer consumption. And it was almost like this scarce resource that was just naturally compensated by the free market. And that's no longer really the case, because if you're 55 years old and looking forward to retirement and saving a bunch of money and you want to defer consumption, so do so many other people. And there's just always going to be a supply of such people. Now, I mentioned that I appreciate how Brian focuses on a variety of different metrics. And I would say that we really should look beyond just what the national debt is to a more unified accounting of kind of all of the different assets that the US holds, the US public holds, and that we might be leaving our children. You could say a lot about how 20 or 30 trillion dollars worth of treasury bonds and obligations seems like a very big number. But it's also the case that the overall bond market is substantially larger than that, nearly $100 trillion. The value of land in the United States is kind of in that same ballpark, and global equity markets also are kind of in that ballpark. We just have a ton of different assets that are owned privately. A lot of them aren't even on the books anywhere. There's people own various sorts of private businesses that aren't publicly traded. There are universities, there are all sorts of things that kind of generate a long-run healthy society that could afford to pay more taxes in the future, that aren't necessarily accounted for in any sort of combined total. And we don't appreciate the extreme value of those enough relative to the national debt. And if we did do a comprehensive accounting of those, we would see that they are much larger. One metaphor I think about a lot when it comes to running an economy is consider, say, an arcade that runs on a boardwalk somewhere on an ocean town. And you need tokens to play the games in the arcade. And the long run health of that arcade is not really about how many tokens it's issued, because the tokens are kind of a liability. You have to give people a game in exchange for any token that someone has outstanding. And that's a debt of sorts. But that's actually not the first thing you'd look at when you're figuring out whether the arcade is healthy. You'd look more at whether it's growing in revenues, and to some extent, if it's able to issue a lot of tokens, that's actually a sign that it is pretty healthy. And second, you would have to worry about if you tried to reduce that obligation by taking away tokens from people who wanted to play, that would almost make your life and your business worse. And I think that's quite a bit what happened in around 2006, 2007. There was a lot of deficit hawkism at that time. A lot of people said that Bush was too profligate, that we were spending too much, that we'd given too much out in tax cuts. Interest rates were raised very high, which caused a lot of foreigners to want our currency as well. And there just wasn't enough US dollars to go around. And I think that is kind of the story of how the 2007 to 2008 financial crisis really happened, that policy was simply too tight. So I do think that there are risks to worrying too much about your financial obligations and not enough about the health of your real economy. And with that, I will yield over to Brian.
Thanks, Alan, for the opening statement. Thanks, Jeff, for moderating. I know how extraordinarily busy both of you are, especially Jeff with your job at the Post. So I really appreciate this opportunity to work through this really interesting issue. We often hear today, that today's low interest rates make debt more affordable. In fact, you'd be crazy not to go into more debt, borrow more money to take advantage of these low interest rates. But I think this approach is short-sighted and dangerous for two reasons. First, we are already on pace to add so much debt that even low interest rates will not bail us out. Alan, you mentioned, how much we've been borrowing this year and how much debt we have right now outstanding in the economy. But we face, according to the Congressional Budget Office, $112 trillion in baseline deficits over the next 30 years. That's even before any new initiatives. That assumes the 2017 tax cuts expire on schedule. President Biden doesn't enact anything. $112 trillion is just the baseline borrowing. That would drive, according to CBO, that would drive the debt to 200% of GDP and deficits to 13% of GDP, which is, the equivalent today of like $3 trillion deficits as the baseline. Now, forget raising interest rates. Let's assume interest rates stay low forever. Right now, the 10-year bond is trading at about 2%. The 30-year bond is trading at 2.3%. Let's assume interest rates never exceed 3% again in the future at any point ever. You would still have budget deficits rising to 10% of GDP over the next couple decades. You would still have a debt that over the next 40 years surpasses 200% of GDP and continue rising, even with 3% interest rates, because the structural deficits are so big that even low interest rates will not save you. In fact, I've run the numbers. I have a report on the MI website. There is no plausible interest rate that stabilizes the debt because the baseline debt is getting so big, low interest rates cannot bail us out. That's the danger. And again, that's even before we've added anything. The debt grows so big. This is a concept that should be understood by anyone with a student loan. If you borrow enough money, it doesn't even matter if your interest rate is low, you're still going to be paying a lot. But what if interest rates do rise? CBO assumes that the average government interest rate rises to 4.6% over the next 30 years, which is still lower than the 5% Washington was paying as recently as 2008. That's when you get deficits of 13% of GDP and rising, the biggest debt in the world. Half of all tax revenues just going to interest on the debt. Now, what if things really get bad? What if interest rates exceed the CBO baseline by 1 percentage point? Maybe not likely, but totally not implausible. That extra 1 percentage point rise in interest rates would raise $30 trillion in interest costs over 30 years. That's like a second Department of Defense. $30 trillion in 30 years just from 1 percentage point. In that scenario, you have deficits rising to 18% of GDP. You have interest consuming 70% of all tax revenues. That's just from rates rising 1% over the baseline. Is that likely? I don't know. Is it plausible? Well, let's see. The question becomes, are we feeling lucky? Can we guarantee that interest rates will never, ever exceed 3% ever again at any point in the future? Of course not. Just this past year, the Federal Reserve couldn't even project the inflation rate within 3 percentage points for the current year, just for the current year. So I think it's foolish for some or anyone to hope that we can know what interest rates are going to be in 5, 10, 30, 50 years. The reality, interest rates will probably do what they've always done, fluctuate. And that means interest rates of 4 to 5% are well within the normal historical range of variation. And that's the rate that would basically bring a debt crisis. So my concern with this issue is I don't want to gamble our economic future on the hope that interest rates never exceed 3% again. Because if we're wrong, just like we've been wrong about inflation in the past year and we've been wrong about a lot of things, there's no backup plan at that point. So the term of the day for me is risk management. Let's not put ourselves in that dangerous of a situation. Thank you.
Thank you guys so much for those statements. Also, just, if you're watching this at home, feel free to start submitting questions and we'll begin collating them, and I'll move to those a little later in the program. I think my first question is going to be for Brian. Debt held by the public has tripled over the last 15 years or so. And in that period of time, interest rates have gone down. And just to set aside the question for a second, which we can get into later about whether even at current interest rate levels, the debt amounts to a severe problem that needs to be addressed. Let's set that aside for a second and just go to the question of whether we should be concerned about an increase in long-term or short-term interest rates. We've heard again and again this concern that piling on to the national debt could lead to this interest rate spiral that we've been hearing, I think, primarily from the right, being warned about all the way back to Bowles-Simpson. And CBO, as I understand it, has had to adjust its projections, I don't know how many times, but a lot in the last 10, 15 years. Has that at all prompted you to rethink where you were when you were making those you and others were making those warnings 10, 15 years ago? And why should we believe that interest rate increases are more of a threat now than if they keep on being proven? At what point would you say, okay, we should acknowledge that this is a different era, or is the threat always there and we should be ever vigilant?
I think economists and forecasters and markets have done a really bad job forecasting interest rates. Almost, as you mentioned, almost nobody forecast the decline in interest rates we've had. What ended up happening is debt still does, there's a voluminous research out there from everyone from Thomas Laubach, CBO, Furman and Summers, showing debt still increases interest rates. But what happened over the last couple of decades is the interest rate upwards effect from debt has been balanced out by other factors pushing down interest rates. Baby boomer savings that Alan mentioned, declining productivity. There was a global savings glut, a lot of extra savings. The Federal Reserve and the soft economy kept rates low. Those factors more than compensated for the interest rates pushing, the debt pushing interest rates up were more than compensated by those other factors. The danger moving forward is as we keep building debt, we're going to build enough debt that according to most of these models would by itself add 3 percentage points in interest rates. The question is, are those other factors going to keep offsetting it and pushing interest rates down? Those other factors can't just stay neutral. They have to become more aggressive to offset the debt. Is that going to happen? Well, let's take a look at this. You're going to have an economic recovery at some point. The Federal Reserve is already signaling that they're going to raise interest rates. That's going to push things up. On the demographic side, the baby boomers, as Alan points out, saved a lot of money in their 40s and 50s. They're now retiring and they're going to draw down those savings. As pretty much the last of the baby boomers are going to be retired by 2030, they're going to be entering a period where they're drawing down savings. This has already happened in Japan, where their much older population has had household savings among the elderly has significantly dropped in previous years because they've gone from savers to drawing down savings. You could have any sort of productivity hike. Hope if we're so lucky. The global flight to safety is slowing down. Like I said, the Federal Reserve is putting pressure upwards. You need those factors to become more aggressive downward to offset debt. I think when CBO says we'll probably go back to about 4.5% over the next 30 years, again, that's not aggressive. That's still below what it was in 2008. And so I'm not forecasting rates of 7, 8, 9, 10% like we've had in the past, but 4.5% is pretty normal historically. I think it's a fair guess. And even if you don't believe for sure it's going to happen, I'm not comfortable gambling the entire economy on the guarantee that it won't happen and building up that much debt.
Alan, I hope this isn't too, I have a specific question for you, but I was hoping you could just first respond to Brian's point, and I think it sounds technical, but I think it's kind of at the center of all of this. You argued, I thought, quite persuasively that, and you mentioned in the beginning of this, but you also have a piece that I urge everyone to go read on this very question, that a seismic shift in global interest rates, particularly U.S. interest rates, has been this demographic change where you have more people saving, and that as a result driving down rates because demand is higher. Brian has this counter argument that says that may have been true and it may have helped suppress rates, but now these people are going to be retiring, they're going to be drawing down savings and going to be consuming, at least in the U.S. Could you take that point head on and address whether you think there's a global trends that offset that or not?
Sure. So the term baby boomers, I mean, that is a very U.S. centric term. It's literally a part of U.S. history. The people came home from the war and all of that. But interest rates are a global phenomenon overall, or at least real interest rates are. And we have low real interest rates. And then because the U.S. has generally, although not in the last year, contained inflation, the U.S. has also had very low nominal interest rates. I expect that the inflation is going to be contained over the next couple of years, but that's a topic for another time. The thing about global interest rates is that they're low everywhere. Japan borrows at low rates. Germany borrows at low rates. And it's not just the countries. It's also all of the assets, all of the stocks, all of the houses. For example, people get shocked that some of the tech companies are now worth $2 trillion or more. And sometimes they're worth that, even though, the price to earnings multiple is very high and lots of value investors complain about it. And they say, why is this price to earnings ratio so high? Well, price to earnings is also an inverse of earnings over price, which is essentially an interest rate. And high PE is low interest rate. You can look at houses. People are like, why are the prices of houses so high relative to rents. And they aren't just talking about in the US and New York and California and such, but also in Toronto, in Vancouver, in London. Just everywhere, people want claims on the future and are willing to spend a huge amount to get them, because claims on the future are unfortunately scarce and a lot of people really want to save. So with interest rates being a global phenomenon, it's important to think about global demographics. Back when Ben Bernanke first started talking about the global savings glut and hinting at the aging population issue, he was mostly talking about the US. But that was 15 years ago now, and or 17. And back then, the median person in, say, India would be in their 30s. And we're approaching a situation where even in countries that we used to think were fast growing, even now their median person is in their late 40s or 50s. And that's especially true of the wealthier markets that have the most pull over global finance. So I don't think it's just about one particular generation. It's a more generalized phenomenon of every single generation is going to be richer than the last and want to fund a huge, long retirement.
And Alan, just a question for you. I know you said that that the current COVID levels of emergency spending are not sustainable, but the main position I think in this debate that you have is that long-term interest rates are likely to stay suppressed. In a world in which either interest rates rise or the scenario that Brian laid out where the debt to GDP ratio continues to escalate, do you think there are risks for the US either in terms of crowding out or any other kind of fiscal constraint that policymakers should be alarmed by or aware of, even if it's not, I guess the fundamental question is, even if interest rates stay relatively suppressed, and this is a new, paradigmatic, environment for the next 20, 30 years, should policymakers still be concerned by the scenario Brian's raising, that even a 1 or 2% increase in interest rates can cause debt to GDP to reach 200, 300%?
So if we stipulate that interest rates stay low forever, then actually, as long as GDP growth exceeds interest rates, the debt does converge. Sometimes it converges to scary numbers, but that's a mathematical truth if you have constant primary deficits. Now, if you keep on promising more and more stuff and never stop, then you've got a problem. But with interest rates bounded, I'm pretty happy because either if you've got low nominal interest rates, it generally means that people are pretty happy with your currency. They aren't expecting that it's going to lose a ton of value very quickly. And it also kind of suggests that real interest rates are low. So you're not foregoing that much by spending now rather than later. And I do think a lot about the risks to the other side, which are a depressed economy. And I think we averted that in the 2020s with ample fiscal spending, and unfortunately didn't avert that in the 2010s.
Yeah, actually, Brian, can you take that on? Like, that seems like a very almost like uniform position on the broad left of center, that there was tremendous economic scarring in the response to the great financial crisis, 2010 to 2016, or even further, that, millions of people were unemployed, wages stalled out, and the debt thing that people were worrying about didn't really materialize. I mean, isn't that a real human toll that policymakers, isn't there a cost to being too alarmed about interest rates if they continue to stay suppressed? Isn't there an opportunity cost on the other side?
Well, I think we can separate short-term economic relief during recessions, which is not even remotely driving the long-term problem versus the long-term structural changes. I'm less of a Keynesian than almost anyone, and I'm not a very big proponent that Keynesian stimulus does much for the economy. I think the multiplier is very low, but I don't really think the argument against some of those policies is necessarily budgetary. We're not going to go broke because of $1 trillion spent on a stimulus or relief checks in the economy. The danger is the $112 trillion deficit that I mentioned that CBO forecasts over 30 years. That is almost entirely Social Security and Medicare shortfalls over the next 30 years. Over the next 30 years, according to CBO, Social Security over the next 30 years is going to be $20 trillion short. Medicare is going to be $47 trillion short. And the interest costs of just borrowing to make up those shortfalls is responsible for $45 trillion in interest costs projected by CBO. So there's your $112 trillion. Basically, outside of Social Security and Medicare, the 30-year budget is balanced. It's entirely a Social Security and Medicare problem. If we have to do $1 trillion here or there because of a pandemic or recession, we can afford that. The problem is the structural deficit. In 2051 alone, Social Security and Medicare are going to run a deficit of 15% of GDP. Two programs are going to run a deficit of 15% of GDP. You can't recover that. That's my concern. That's what we have to get under control. It's not the stimulus stuff. It's that.
I could keep going with questions all day. Do you guys have questions for each other? Alan, do you want to ask anything of Brian or push back on anything, or vice versa?
Yeah. So one thing that I wanted to bring up that kind of got past me was the CBO's projections of interest rates. They've been on the high end for a long time.
Oh, yeah.
Whenever they revise it down, not up. And they've been kind of chasing a serial overestimate now for about 10, maybe 12 years. And even now, the 4.6% number that you mentioned, well, when you look to actual U.S. bond markets, where people are betting with money on the line, actually a lot of money, the U.S. 30-year Treasury is at around 2.25%. And there's a long way to go between 2.25 and 4.6. And by all means, if we start heading in, the 4.6 direction, I would update my beliefs to be more in your direction. I would say, well, we are living more in a Brian world now, so I got to be more like Brian. What's the marker by which you would update your beliefs to be a little bit more in my direction and say, well, these problems don't look as bad as I thought?
It's a great question. I think, obviously, if interest rates never move, then I think not only do you win the bet we made, as background for the audience, Alan and I have a $100 inflation-adjusted bet of whether or not interest rates will exceed 4.6% at any point in the next 30 years. I would love to lose this bet. I hope you're right. If we go 10, 15 years and interest rates are still at the current rate, you bet I'm going to be very happy and I'm going to update some of my assumptions. But I'm going to have the caveat that we just never know. Past interest rates are not indicative of future trends. Again, just this past year, the Federal Open Market Committee couldn't even get inflation for the current year within 3 points. 15 years ago, we were told the housing market could never collapse. Then it collapsed. 20 years ago, we were told the NASDAQ bubble would never collapse. That collapsed. And so I don't know if I'm ever going to move away from the view that interest rates will probably fluctuate in the future. They're going to go up sometimes. They're going to go down sometimes. I don't think we can ever declare permanent victory over high interest rates any more than we can declare permanent victory over inflation or permanent victory over the business cycle or anything. But if we go a couple decades and we're staying at 2%, I will be much more relaxed and happy. that we're not getting into the 3% or higher danger zone.
Brian, do you have a question for Alan based on?
Sure. I hope you're right on interest rates. I hope they never rise. My question is, what's the backup plan if they do rise? I mean, if we lock in all this debt for the next 20 or 30 years, $112 trillion, and then interest rates do spike, let's say they do go up to 4 or 5% at some point 30 years from now, you've already locked in all the debt, most of which is going to baby boomers who are retired that you can't really pull back. The debt's already baked into the cake. Interest rates are rising. What's your backup plan if they do suddenly rise to 4.5 or 5% in 30 years? What do you do at that point to get us out of it? And I'm getting to the risk management issue. Is this seems like a very big gamble? If they do spike, how do we get out of it?
I suppose this is one of the times when there's a saying that from Scott Sumner of Mercatus, never reason from a price change. You kind of have to know why the price has changed before you can answer a question about it. And I think it would depend a great deal on what was the reason for the interest rate spike. One example I come up with to kind of illustrate like what would create a change in the paradigm. Say that some zany entrepreneur like Elon Musk or whomever comes up with a really like radically productive idea for a $200 trillion space station that once we finish constructing it will provide us with tons of cool stuff and lots of interesting things that people want and need and make us much, much more productive. That would be a really capital intensive investment, creating more demand for borrowing, demand for people who want to kind of preserve, demand from people who are willing to defer consumption so that instead their money can go to the construction of this space station. And then we're super productive later once it's done. That would create a rise in real interest rates, and that would kind of be a happy one in a lot of respects. And it would mean that paying down the debt would be good, but it would also mean that we're much, much more productive in the future, and we're in a much better position to pay our debts than we thought we were. Now, if it's more like people are spending faster than I anticipated or than governance economists anticipated, and you see fast accelerating nominal economy, everyone's getting raises everywhere, but also prices are all going up and the dollar is losing its value quickly. Well, then you've got high nominal interest rates because of the inflation side. And then at that point, you just got to tighten things up. At that point, you got to put the Bryans or their counterparts on the center left in charge, and they've got to make some tough choices. So, I mean, there is a point at which you do have to put the kind of rigorous budget-minded people in charge, but you can kind of wait for the markets to give you that cue first. Each little point that the 30-year Treasury rises, you get closer and closer to adding more budget hawks to your departments and a little bit away from the kind of abundance mentality that I've been advocating the last 12 years or so. But right now, with interest rates low, I think we should remain on the abundance mentality side.
Alan, I'm glad you brought that up because I feel like it was the direction of my next question. I was hoping you could talk a little bit about the example of the Transcontinental Railroad that you brought up in your piece and just sort of articulate the link between productivity, global productivity and US productivity and interest rates and why that is sort of in your mind a buttress to your argument. And then as a corollary though, I wanted to ask if the low interest rate environment is contingent on productivity being low, isn't that not exactly an ideal outcome? Shouldn't policymakers be desperate to improve productivity gains? And doesn't that call into question the desirability of a very long-term low interest rate environment. But I first think it would be fun just to hear you. I thought that was just such an interesting example, and I don't know if you know the specific figures offhand, but talk a little bit about that example and how it illustrates your thesis, and then why you are not concerned about a potential shift in productivity.
Yeah, so the piece that Jeff mentions came from Full Stack Economics. It was actually the first piece I wrote for it. And it's about why I think low interest rates are here to stay for the foreseeable future. And kind of the 19th century version of that super expensive space station was railroads. We were building railroads everywhere in the 19th century, and they were super expensive relative to GDP. So these estimates are a little imprecise because statistics weren't as well kept back then, and historians kind of have to piece it together. But for a sense of the scale of the Transcontinental Railroad, for example, the Central Pacific Company put out an advertisement in the Sacramento Union for 5,000 workers to work on the railroad at a time when Sacramento had only 15,000 people in it. In terms of the cost of the railroad, it was maybe something in the range of $100 million at a time, and that's in 1860 dollars. It was something in the range of $100 million at a time when GDP was $7 billion. And that was just, one investment, one railroad line. And so there were these huge capital hungry investments where you had to pay tons of workers now in order to get the job done using money from somewhere. And so you really needed to go around and find lenders, and lenders were hard to find. And that was just a very different world from where we are now, where there are tons and tons and tons of pension funds, all searching around for asset classes and alternative asset classes, places where they can put their retirees' money and get a return off of it. And so they're going into venture, they're going into all these things. They're willing to use very high multiples. They're willing to accept very low rates of return. And that's because the balance of savers versus people who are hungry for investment is just very different. And part of that's also like the nature of investment today. The sorts of things that are being built today are often like, some company that turns out to have a really cool website that lots of people like, and they have like 25 employees to start, and it spreads like wildfire anyway. That's not a capital hungry investment. We can argue about whether such websites are productive or cool or actually enjoyable or kind of a waste of time. But that's kind of the nature of like a lot of super successful companies today. And the key thing about that economically is just that they don't have to pay that many people. They're not hiring 5,000 people out of a town of 15,000. They're hiring like 20 computer programmers. And perhaps we should be kind of sad about that. It would be much more interesting to live in the world where like dramatic physical transformations were happening and huge numbers of people were working on investments that would make the future more interesting. But that's clearly not the world we live in right now. And I don't think there's necessarily a policy prescription for that. You can't figure out what the policy inputs are such that you get a technological advance as cool as railroads. That's not a thing you have control over. But in some ways, like the economy of 50 years ago or 100 years ago feels less stagnant than our current economy.
So I think and thank you guys so much. We're gonna get to some of the audience questions. I'll just throw this one out there, maybe add a little addendum. Someone writes, can you explain the specific mechanisms that force in quotes, other countries to accept low interest rates on US treasuries? I think maybe a related question that I have is sort of maybe for Alan, if the Fed is going to pare back some of its purchases, bond purchases, what does that mean for who absorbs that? Is that a risk? But yeah, if you could take on that reader question about what mechanisms force other countries to accept low interest rates?
Well, there definitely is kind of a global market on currencies and interest rates. And actually, you can there are a bunch of mathematical principles about if the interest rate in one country is this and the interest rate in the other country is this, here's the exchange rate you have to have, and here's how all the futures contracts will work, and so on. And there's a whole developed market there. If other countries found some way out of the low interest rate trap, for example, they had people who lived forever in perfect health and therefore didn't need to save because they could always get additional paychecks, or if they had a bunch of really capital hungry investments they were super excited about, then they wouldn't really have a need to invest abroad and diversify or anything. But typically other countries have just as low interest rate a situation as we do, unless their country is unreliable in some way. So for example, like Germany and Switzerland, those folks are dealing with low interest rates as well. And maybe, if you're in Turkey or Argentina, you're not dealing with low interest rates, but then you would have reasons not to trust your own country's financial obligations, and you'd maybe want to get your money out of the country. So there isn't some good deal elsewhere for people to accept. The interest rate on US Treasuries is fundamentally fair in the sense that it accurately reflects the balance of power between lenders and borrowers right now.
And for Brian, another viewer writes, what non-financial events could cause a rise in interest rates, geopolitical or energy-related or demographic trends? I think we've discussed demographic trends, but maybe, what else could be keeps you up at night?
Thanks. Well, first, I just want to mention just a quick point on the international. There is an assumption that's widely held that while other countries can help us finance a huge portion of our debt, I just want to mention that of all of the borrowing we've had since 2011, China and Japan have financed just 1% of our debt, the new debt in the past decade. When we've borrowed the majority of the debt we have, China and Japan have financed just 1% of it. The vast majority has been financed domestically and will continue to be financed domestically because the debt is so big that China and Japan aren't even going to come close to making a debt. So it's really going to be, MMT people will say the Federal Reserve, but it's really going to be mostly American investors, bondholders, mutual funds, retirement funds that are going to have to take on that $112 trillion, which is going to be a lot. In terms of this question about what can raise interest rates, other than the economy, we have talked about things like demographics. Again, we've already seen it in Japan, where the elderly in Japan at a certain age, around 65 or 70, they are actually drawing down savings and reducing savings in Japan. We're going to get some of that here probably as people retire. They're going to start drawing down savings. We'll still have some savings. We're always going to have people in their 40s and 50s savings, and not all baby boomers are going to draw down everything. But compared to what we saw in the past 20 years, that demographic is not going to keep up that same degree of savings. You also, again, we've talked about, some of the economic factors like productivity, global savings glut, flight to safety. But there's also just unknown unknowns that can affect the economy and interest rates. The past 2 decades, we've had all sorts of unpredictable events. Right now, we have a pandemic that's been wreaking havoc on the economy for 2 years. There's always these tail risks and black swan events that can roil markets: wars, financial crises, pandemics, environmental catastrophe, cyber terrorism. You never know. And that's why, again, it's so dangerous to say we're going to base our economic policy on interest rates never exceeding 3% ever again, because you just don't know. And markets get it wrong, and people get it wrong, and forecasters get it wrong. Nobody forecasted a big pandemic in 2020. And so I'm like I said, risk management is the term of the day.
Another viewer writes, do you have a view on how to judge the debt capacity of the economy? And this is obviously a sort of a technical question, but as reporters, we wrestle a lot with debt to GDP and what's the right kind of measures to be thinking about. Alan, I mean, since you're on the other side of this, what is the right metric to start thinking about some of these questions?
I would absolutely go with interest payments as a percentage of GDP, and you can probably do a little bit better than there's like you can look up that graph on Fred, the St. Louis Fed's website. It's a great website. You can probably do a little bit better than that by projecting it out prospectively using market rates, knowing that some of the debt that they're currently holding and paying interest on is going to be rolled over at the new interest rate. So you can probably improve on that metric somewhat. But that's the best one that I would know of. The reason for it being better than debt to GDP is it's a proper flow to flow ratio rather than stock to flow. And I don't trust stock to flow ratios, especially because kind of the whole deal with low interest rates is that every stock flow ratio in the whole economy gets larger. And, you get real estate people wondering why buy to rent ratios seem so off. And you get value investors wondering why PE ratios are so high. But it's all the same thing. It's all that interest rates have gotten lower and you're getting used to a new normal.
Brian, is that right? I mean, is the debt to GDP
better.
number somewhat misleading, and should we look at some of that?
Jason and Furman and Lawrence Summers wrote a very interesting and helpful report a couple of years ago, I think about a year ago, where they talked about interest as being the most important measure, interest as a share of GDP, because that's the cost of the debt. I think that is the most important thing too, but I'm going to say I don't think it's the only important thing. I think the interest cost that's how much we're paying for this in terms of our tax dollars and the federal government. Now, Furman and Summers had suggested trying to stabilize the debt at about 150% of GDP would then, in terms, they say, bring the interest cost to about 2% of GDP in real terms, which was their preferred target. I'll say 150% of GDP is lower than the baseline. That would require some fiscal consolidations because the baseline is going closer to 200. So I do think if you can stabilize, let's say, nominal interest at about 3% of GDP, that's probably a level that can avoid us from having to significantly keep raising taxes or cutting spending, which would mean not adding a lot more debt over the current 100% of GDP. That being said, I don't think the debt to GDP or total debt is totally irrelevant for a couple reasons. First off, I want to know how much the total debt is because that's our total exposure if interest rates rise. Because we can control the debt, but we cannot control interest rates, we have to be careful that the debt is not too big because you never know what's going to happen to interest rates and drive it further more uncontrollable. Second, there is a degree of debt reducing investment in the economy. CBO estimates that every dollar of federal government debt reduces investment spending by 33 cents on the dollar, and that ultimately reduces economic growth and wage growth. So that's one area where I think you do want to look at total debt. There are investment factors. Also, total debt, has shown, according to CBO's numbers, that it does reduce wages and income, in part because a lot of the money is going abroad that we pay interest payments. CBO says that we're going to lose $6,300 in GNP per capita by 2050 as a result of current debt. So I think current debt matters. It's our exposure to interest rates, it's investment, and it's GNP. But I think it matters as a secondary factor to the more direct, immediate harm, which is the interest cost as a share of GDP that's already projected to become the biggest expenditure in the federal budget over the next couple of decades, even with modest interest rates.
Alan, do you have a thought on that question about private investment?
I would say that's absolutely a live issue as interest rates get higher than kind of the very low levels that we have here. I mean, right now we're still even at zero in the short run and only at 2% in the longer run. But certainly the interest rate on U.S. Treasuries does have kind of a hurdle rate effect on the rest of the economy. It's a marker of kind of how much where the balance of power between borrowers and lenders is. And I actually like when the balance of power like pretty heavily favors borrowers in real terms. I like when entrepreneurs are able to get a low cost of capital and invest in cool stuff for the future. So it would be important to me to keep real interest rates relatively low, but I do want to keep off of that zero lower bound, which we've been at a couple of times now in my adult lifetime.
The last question we have here from viewers, and get them in if you have any lingering ones out there. I will confess to not understanding this question, so hopefully you guys can explain it to me. Is it time to consider a sinking fund to start discharging the debt? Either of you want to take on that idea of a sinking fund?
Oh, for me?
No, either. I don't know. Either way.
I would say that if you want to get the federal government to a kind of net zero balance sheet, there are kind of two ways to do that, and neither of them seems that appealing to me. The first way of doing it is you just retire all of the risk-free obligations. You retire all of the dollars and all of the treasuries. But, well, people actually need dollars and treasuries. They need them to have kind of a baseline legal tender option. And then the other way of bringing the federal government back to kind of a net zero financial obligations is to have it invest really, really, really heavily in all sorts of stuff. Build up this huge, like $20 trillion portfolio of government-owned assets. And there absolutely are tens of trillions of dollars worth of assets in the US. There are hundreds of trillions, in fact. But in order to do that, you would kind of have to have the government running a massive, massive hedge fund. And neither one of those seems really happy to me. And instead, I would kind of prefer that the government retain its ability to collect taxes in the future on various private sector investors who can hold on to those assets and take care of them. But the government takes a cut, and that's how it finances itself.
We got one more question. Someone mentioned that capital-intensive projects outside the U.S. would draw money away from U.S. treasuries. Is something like the Belt and Road Initiative in China large enough to make an impact on that question? Brian, you have thoughts on that?
I mean, again, China and Japan have, as our debt has hit $23.6 trillion, the publicly held debt, China and Japan have combined gone from 2.2 to 2.3 trillion dollars in holdings over the past 11 years. And I'm not sure necessarily that they're drawing money away, not just from China itself or Japan or other countries. I don't think it's drawing that much money away from what would be going to the United States. Again, the vast majority of the $112 trillion in borrowing over the next 30 years is going to come from the United States. The global economy just doesn't even have the capacity to make a big dent. Like I said, China holds about $1.2 trillion out of our $23.5 trillion. They're not going to be able to do much out of our $112 trillion. Interest rates are global and they're determined globally. But I do think we're going to be mostly looking domestically at financing much of the future debt because the numbers are just too big for some of these other countries. They just don't invest that much in our treasury. So I don't think it takes too much away from us. I think this is mostly going to be a domestic issue.
Okay, well, I think that wraps us for this event. I'm glad we were able to settle this question once and for all. And thank you all for joining us. Hope to do one of these again soon.
Thank you very much, Jeff. Thank you, Brian.
Thanks, everyone.